who are the managing director and has asked you to take over from the colleague and provide urgently the needed estimates of the discount rates to be used in appraising a new capital investment. And they've given you the working notes already. What else have they told you? The company's gearing level is 1:2. After tax earnings is available. All that is given. And they're asking you to calculate the weighted average cost of capital. So we've not done a question on WACC. So that's the reason I chose this question. So they're asking you to calculate your weighted average cost of capital. That is using dividend valuation model and your capital asset pricing model. You very well know what is the difference between dividend valuation model and your capital asset pricing model. What is the main difference between the two models? Quickly tell me in the chat box. When do we use DVM and when do we use CAPM? Respond. Yes, Edwin. Where risk is taken, we use CAPM. In your DVM, there is no risk factor taken into consideration. All right. Okay, you're on the right track. So can you all calculate the weighted average cost of capital? So whenever you are starting a weighted average cost of capital problem, what is the first step? You have to check what are the sources of finance. How has this company raised finance? So just by looking at it, I think it has raised finance only through debt and equity. Correct? Sources of finances, debt and equity. So I told you all know the format to follow. So what I'm going to do is I'm going to write over here. As usual, we have to make it very clear to the examiner what we're trying to convey. So calculation of weighted average cost of capital. Okay, using dividend valuation model. Later we'll be doing using CAPM as well. So this is the format. So first thing is sources of finance. How have I raised? How have I raised? Only debt and equity. Correct? Debt and equity. And you know, in weighted average cost of capital, until and unless they specifically tell you solve it in book values, it is always calculated using the market values. So our second step will be to calculate the market values. And you know how to calculate market value. Number of shares into market price of the share or number of bonds into market price of the loan note or bond. Calculate the market values. How much is it? Let's go through the question. So here what has happened? They've not actually given you the market values as such, right? They've just given you the ratio that it is 1:2. So this should be enough because usually why do we calculate weighted average cost of capital? So that we get the weights, right? What do you mean by weights? The proportion. What do you mean by proportion? The amount of each source of finance when compared to the total source of finance, right? So with this much information, we can calculate the weights, right? So this is usually used when we're doing a full-fledged WACC problem where we only have to calculate the market values. That time we can use this. But since over here, weights are already given to us. That is, it is 1:2. So 1:2 means what will be the weight? Tell me. 1:2 means what are the weights? What is the proportion of debt and what is the proportion of equity? They've told debt equity is how much? 1:2. So when they give you 1:2, what does it mean? Debt is 1, equity is 2. I hope everyone's aware of it. Yes, ma'am. Yeah. So over here, we know that debt is, I'll just write, debt equity. Debt equity is 1:2. So that means debt is 1, equity is 2. In total, it is 3. So can I say it is 1 divided by 3? This is the weight of debt and 2 divided by 3. This is the weight of equity. Everybody understood this. You know, this plus this. Okay. Then what do you do? Then you have to multiply it with their respective cost of capital, which you will have to calculate now. Have they given you for, of course, for dividend valuation model, you only have to calculate. And what about debt? Can you calculate using dividend valuation model? What is your cost of equity? What's the formula for DVM? DVM is D0 into 1 plus G divided by P0 plus G. So they've given you enough information to calculate your cost of equity. So tell me. Dividend is given to you. Then your growth rate is given to you. All you have to do is calculate. Tell me. Are you guys solving or am I talking to myself? Please let me know that. Okay, Ashwina has given me the answer. Very good, Ashwina. That's the right answer. So here you just calculate the DVM. Okay, Khatija, check your answer. Is it 8.5? No. What is the dividend? Dividend is given to you in the question, no? How much is the dividend? No, Edwin. Everybody, be very careful. Let's start. After tax earning. Tony, check your answer. Most of them are giving me 7.4%. Why is that? Please be careful. Whenever they ask you dividend valuation model, the one way that they'll trick you is they'll give you the dividends in dollars and the share price in cents. So be smart enough to convert those cents into dollars or dollars into cents, because you know basic maths. Whenever we do, it should be of the same unit. You can't have your numerator and denominator and your denominator. I mean, yeah, you can't have your numerator in dollars and denominator in cents. That won't make sense. Okay, so that's why what do you have to do? You have to either have same unit. Okay. So here what have they told? After tax earnings available to ordinary shareholders in the most recent year was 5.4 million, of which 2.14 was distributed as ordinary dividends. So see, the dividends is given to you. Okay. And the company has 10 million ordinary shares, which are currently trading on the stock market at 321 cents. So do you see? Yes, Khatija, that's the right answer. This share price, the market price of the share, that is your P0, is given in cents, right? All right. So then what else do you need in your to calculate your dividend valuation model? Your dividend and your growth rate. Have they given you the growth rate? They've given, no? Growth rate is 11%. It's given to you. So then why is that you are not getting the right answer? Only two of them have got. What's the reason? Growth rate is 11%. How much is P0? 321 cents. 321 cents means how many dollars? All of you know $1 is equal to 100 cents. So 321 cents is
3.21.
yes. You're going to divide it by so 3.21. Then what else do you need? Yes, Nathan, right answer. Edwin, Tony, did you all get the right answer? So growth is given, P0 is given. What is your dividend? Okay, one more mistake more, and the share price is given on a per unit basis. This is another way that they'll trick you. In your dividend valuation model, the two ways that the examiner can trick you is one, when they quote few figures in dollars and few in cents, and second, when they quote in total and on a per unit basis. Now see over here, your dividend is given on a total basis. Share price is given on a per unit basis. So how can you take them? So this is the second clue. So now Tony, Edwin and others, can you all tell me what is the answer? You can't take dividend in total and your denominator in per unit, right? So now do it. Okay, let's check that, Nitin. Yes, Tony, now that's the right answer. Is it clear, everyone? Either convert your whole dividend on a per unit basis. That is, this is the total amount of dividend. How many shareholders are there? 10 million. So how much will it be? 2140,000. 0.214. I hope everyone's got the answer. Should I do it or have you all got it? So they've given the total dividends, right? So what do I have to do? How much is their total dividends? Either I have to convert dividends, total dividends on a per share basis, or I have to convert, or I can take my share price, right? They've given it in per unit basis. Take the entire market cap by multiplying it into 10 million. So it's up to you. Which one do you find it easier? What is dividend per share? Can I say 2140,000 divided by 10 million shares? 10 million shares means 100 lakhs. So this is your dividend. So now apply your formula. Dividend is 0.214. Now on a per share basis. Why? Because the share price is given on a per share basis. Into 1 plus G. G is 11%. Divided by your market share price is 3.21. The whole thing plus 0.11. What's the answer? Around 18.4%. Is this clear, everyone? Did everybody get this? Yes or no?
Yes, ma'am.
Okay, perfect. So your cost of equity is 18.4%. What about your cost of debt? How much is your cost of debt? Have they given it to you? Yes, the corporate debt may be assumed to be risk-free. The company pays 35% and okay, personal taxation might be ignored. So how much is my debt? So they have told you that the corporate debt is risk-free. So what can you assume? Which rate can we take? Risk-free means out of the information given to us. Okay, out of the information given to us, which one is considered to be the risk-free rate?
Treasury bill.
Very good, Edwin. Any? The moment you hear this word US Treasury bills, right, or gilts, these are all risk-free interest rates. So obviously, this is my RF. And they have only told us that corporate debt may be assumed to be risk-free. So what are we assuming here? That this is my cost of debt. But does it end here? So should I go and write 12% here? Is this correct? Yes or no? No. Why? Because you all know that cost of debt should always be, complete the sentence.
Acceptable.
Tax deductible. So it should be after tax. Why? Because I am talking in the point of view of the company. So company gets tax relief on interest payments, right? So 12 into 1 minus what was the tax rate? 0.35. So how much is it? 7.8%. Now finish. You know that your debt is how much? 7.8%. And you have already got the weights. So I'll just delete this column because it's irrelevant for us, right? Because usually we make use of this column only if to calculate our weight. So weights is already given to us in the question. So can I say it is weight into their respective cost of capital? And then I just take the sum of. Did everyone get this as the answer? Yes, Ashwina, that's the right answer. %14.9%. Nitin, where did you go wrong? Did you not take the tax? Did you take 12% instead of 7.8%? Everyone, did you all get this? So this was first part of the problem. Yeah, exactly, Nitin. So that's the reason I pick up such problems where, the minute things have to be taken care of. Simply, you guys will lose marks, even though you all know the concept and you all can't afford to do that. Okay, you can afford to make mistakes here in the revision session, but not in the exam. Why? Because it's going to cost you. Okay, so shall we go to the next question, next part of the question? So see, the calculation was actually very simple. It was just, they were asking you to calculate dividend valuation model. But see how much of things can, they can twist over here in just calculating the DVM. So please take care of the units, take care of the totals, because those things matter. Okay, so first part of the problem we did. Now can you all do CAPM? Your favorite. How easy it is to calculate CAPM. Beta is given, RF is given, market rate is given. So calculate your KE using CAPM. Okay, Nitin has already given me the specific cost of equity. Yes, that's right, Nitin. Khatija has given me the answer. Very good. So here if I'm doing using CAPM, it is RF plus beta into RM minus RF. Correct? So how much is your RF? Risk-free. Beta is 1.4. RF is 12. What is RM? Stock market total return is given to you. So can I say 12 plus beta is 1.4? into RM is 12 minus, sorry, how much is RM? 16 minus 12. 17.6% is your CAPM. So what am I going to do? I'm going to calculate. I'm going to use the same format, right? But here it is calculation of weighted average cost of capital. Here I'm calculating the weighted average cost of capital using CAPM. Yes. Only changes will be that I will be changing this part. It is not 18.4%, it is 17.6%. And what happens to your VAT? It is 14.3% now. Is this clear, everyone? Okay. So they say that in theory that both the models should give you almost the same answer. So you can see that even if I'm using DVM or your CAPM, you're getting almost the same answer. Only because of the market imperfections, there could be certain changes in the decimals. Okay, what else are they asking us? So the question is asking us, state clearly any assumptions that you make. So that is clear that we have taken corporate debt as RF. So that is the assumption. Under what circumstances would these models be expected to produce similar values for VAT? Can you tell me when? Answer. So here you're going to talk about that business risk, financial risk, all of that. Okay, those points you're going to mention over here. Yes, Travis, that's a good point. Investment, yes, that's also taken when you're in the same industry. So those are the points. Now, can you do this part quickly? You're now informed. You're now informed that the proposed investment is a major diversification into a new industry and are provided with the following information about the new industry. So now, ill colleague, okay, they're entering into a new industry and they have given you the average industry gearing level. So what does this mean? This is of proxy companies. Proxy companies gearing level is given and the average equity beta is also given. So what should you do? Using any relevant information from part A and part B, recommend which cost of equity should be used for the investment. Any relevant calculation not included in your answer to part A should form part of your answer. Okay. So how are you going to start now? What are the 3 steps? Using the asset beta formula, what will you do? We have done, no? Problems on that? Remember this? Yes, Nitin. Ungear, regear, CAPM. So can I take this format also? Because I want to save time. So what I'm going to do is I'm going to take this format here. So first step is degearing or ungearing. So the formula is given to you already. What should you do? You have to calculate the business risk. Do it. What is it? They've given you the debt equity ratio. If they say 1:3 means what does it mean? Debt is 1 and equity is 3. Correct? Tax rate is also given. Don't forget to take tax. So what will be the formula? Value of equity 1:3, no? So your debt equity ratio 1:3. That means debt is 1, equity is 3. So 3 divided by 3 plus debt is how much? 1 into 1 minus tax rate was how much? 0.35. Correct? Into what is the equity beta? 1.50. So how much is your asset beta? Only Ashwin has given me the answer. What about others? Check your answer, Nitin. So it's 3 divided by 3 plus equity plus debt. Don't forget. It's 1.23. Yes, you can take up to 2 decimal places or 3, Neha. Okay. Next comes re-gearing. What do? With the help of this asset beta, with the help of this formula, you're going to calculate. So you're going to say 1.23 is equal to, now you're ready to invest because you know what is the business is. Now you're ready to invest in this company. So what is your debt equity ratio? 1:2, right? 1:2. That means 1 is your debt, 2 is your equity. So what will be the formula? 2 divided by 2 plus 1 into 1 minus 0.35. The whole thing into equity beta. Can anybody tell me how much is my equity beta? Quick, Ashwina, Neha, very good. 1.64. So when you solve the equation, how much do you get? You get around 1.64 as your equity beta. Now it's simple. RF is given. Beta you just calculated. RM is given. RF is also given. So what's your CAPM? .5%. So what can you tell about this project now? Earlier it was less. My weighted average cost of capital was around 14%, right? We calculated before we entered into a new industry and we saw that it was around 14%. Now that we're entering into a new venture, okay, a new business area, that time what happened to our project specific cost of equity? It has increased. Everybody, are you all with me? I hope everyone's solving.
And can I show the first part of the question?
Yeah, sure.
Thank you.
Okay, guys. So over here, we have used relevant information and we have also calculated. Recommend which cost of equity should be used for the investment. Should I use 14% or the one which I calculated, 18%? Which one to be used? Obviously, the 18.56% because it reflects the risk of the company. See, Travis, when I'm entering into a new business venture, I will have to factor the business risk and financial risk of that new venture. My old weighted average cost of capital will of be no use because it is not factored risk. Correct? So that's why we calculated risk adjusted discount rate, or also known as specific cost of equity. Yeah? Okay. Okay. So which part, Soumya? This regearing part? Yeah, why 18.56? Because we are entering into a new business area, which is not similar to our earlier one. So whenever we are entering into a new business area, what happens? We cannot use the old weighted average cost of capital. Why we cannot use the old weighted average cost of capital? Because it does not. Okay, guys. Yeah, tell me. Why is it necessary to value business? Okay. Nathan says during acquisitions, mergers, to value the company. Yes, Neha. So these are the various reasons why we value business, right? And why do they say that business valuation is an art and not science? Because each one, how they value a business might be very different, right? Like I might value a business based on how much earnings it has. You might value a business based on how much assets it has. Hadi might value a business based on how much dividends they pay. Neeraj might value a business based on how much cash flows they have. So each one values the business differently, and that is the reason business valuation is an art and not science. Because if it was science, then whichever way you value, you should get the right answer. But art can be anything, right? The way I draw something might be very different from how you draw it. So this says because each company have a different perspective of valuation. So that's the reason. The first statement, what they say is business valuation is an art. So if I value a business based on asset-based method, I'm going to get a different answer. Based on earnings or yield method, different answer. Based on cash flows, different answer. So that's why they say business valuation is an art. Okay, that's about it. So we all know that we can value businesses differently, and I hope everyone knows how to calculate it, the formulas and everything, because this is a revision session. So it is assumed that you all know it already. Can you all see the screen, everyone? So nature and purpose, why the valuation is required, what information. So you have four methods: asset based, investment, income or earnings based, dividend valuation model, and your discounted cash flow basis. So in this way, we will be calculating the value of the business. Okay. So now I'm going to go to the handout. We were going to solve a question, no? I think it was section B type question. Everyone can see the question? So they've given you the financial statement and the balance sheet also. And they're asking you what is the value of Bluebell company if they're using net realizable value method. So go through the question and tell me what is the answer. Now let's see who will give me the answer. The handout is already shared with you. Anybody with the answer? Are you guys there? Guys, can you all see the screen and are you all solving?
Yes, ma'am.
Huh. Okay, most of them have given me the answer. Edwin, Khatija, check your answer. Have you deducted the liabilities, Khatija? Yes, Neha, Ashwina, all of you have given. Who can explain this? Who will go ahead and explain this answer? See, guys, that's when you explain something, no, that's when you'll remember better. So, who will go ahead and explain this? Yes, Khatija, now you've got the right answer. Let's go to, so C is the right answer, everyone. Next question. What is the value of Bluebell company using the earnings yield method? Okay, do it. Okay. I've got the answer for B part of the question also. They're saying it's 1875. Yes, that's the right answer. All those who have got 1875, you all are in the right track. Correct answer. As you know it, right? I don't have to solve it because this is very simple. So the general mistake that in question number 21, that was when they asked you to calculate net realizable value, most of them will take goodwill also into consideration. So you know that in asset-based valuation method, we do not consider goodwill, right? That is a drawback of asset-based method, that it takes only tangible assets into consideration. So that's the reason we had to ignore goodwill in calculation, which most of you all have done. You're on the right track. This question also, yes, C is the right answer. Did everyone get 1875? You all need to know what is the formula for earnings yield method. It is nothing but the inverse of PE ratio. So it was quite simple. Then comes your C, 23 part. When valuing, it's a theory question, okay. When valuing Blue Bell company using asset-based valuation, which of the following statement is correct? That's the right answer. An asset-based valuation method will be useful for asset stripping. What is asset stripping? Explain asset stripping. No idea?
Sole purpose of buying a company to sell all the assets in it.
Very good. Buying a company to sell off its assets. So what actually happens in asset stripping is process of buying an undervalued company with the intent of selling off its assets to generate a profit. So the main objective here is you buy a company that is already undervalued, and then the intention of buying that asset is to sell off its assets for a profit for its equity shareholders. So you sell their assets, and this happens, your asset stripping happens in a very unusual situations. Okay. So that's why, and this is used in your asset-based valuation method. Okay. Next question. Which of the following is or are indicators of market imperfection? Okay, most of them have given me the answer. Yes, D is the correct answer. Okay, Nitin is asking, could you please explain point D? Okay, the previous question, is it Nitin?
Yes, ma'am. 23rd one.
Okay, so that says replacement cost provides a deprival value for Blue Bell company. So here what they're trying to say is that your replacement cost or your replacement value, okay, your replacement value is not equal to your deprival value. Okay, and your deprival value is also not equal to your realizable value. So your deprival value actually comes in between of your replacement value and realizable value. So that's why it does not provide a proper basis for valuing the company.
Ma'am, if deprival value equal to residual value,
No, it's not even equal to your residual value. That's what I told. No, deprival value is a value that comes between your replacement value and realizable value. So that's why it is not a suitable basis to value the company.
okay, ma'am, got it. Thank you.
Okay, so this was quite simple. What was it? Which of the following is or are indicators of market imperfection? Both 1 and 2. And your last question, tell me what is the answer? Which of the following statements is correct? Okay, what's the answer? Yes, Tony, that's the right answer. Neha, Edwin have given me the right answer. Farhan, you can only choose one. So which one will you choose? Oh, yeah. Okay. Got it. We are here. B is the right answer because if you want to take control of a particular company, then obviously you have to pay more. If you're buying 1 or 2 shares, then it's a different thing. Here you are taking the entire control of Dandelion company. So more price you have to pay. As simple as that. Okay. Let's do one more problem. So according to the session, we were going to do one question on risk management now. Perfect. Let's do this now. I hope everyone's gone through the question. Yes or no? Because the handout was shared with you all earlier. If you all have not gone through the question, then I'll give you all one minute to just go through it. And then answer. Sir, in relation to the yield curve, which of the following statement is correct? Yes, Hadi has given me the right answer. Edwin, check your answer. Neha has given me the right answer. No. Yes, Tony has given me the right answer. Edwin, C is the right answer. Okay, so I want everyone to go and read about, not now, afterwards, after the class, read about the theories. So here, C is the correct answer. A kink in the normal yield curve can be due to different yields in different market segments. So please read about your market segmentation theory. What does your market segmentation theory tell you? That different segments will give you different returns, which will cause a kink in the yield curve. Because see, if it is a short segment, then your returns are different. If it's a long segment, it's different. So because different segments provide different returns, there is going to be a kink. What do you mean by kink? A small, this is how it looks like. You might have seen. This is a kink. So that's about it. Okay. Next question. C is the right answer for this. Question number 27. If the interest rate on loan is 6.5% when it is taken out, what is the nature of the compensatory payment under the forward rate agreement? So this is the type of question where they're asking you to calculate. How will you do it? You know what is an FRA? Yes or no? Guys, do you know how to solve this? It's an objective case study question. So how do you start? Peony Company's finance director is concerned about the effect of, okay. So what are they doing? They're going to take out a loan, 100 million loan in 3 months period of 9 months. So this is a suitable FRA. What does this mean? 3 versus 12 means what? It is starting in 3 months time and it is for a duration of 9 months. That is 4, 5, 6, 7, 8, 9, 10, 11, 12. Right? This is how you recognize. This is how you recognize the forward rate agreement. And they've also given you the interest rates, 7.1% to 6.85%. Correct? So what happens in such cases? Now, Peony Company is someone who wants to take the loan. So what will Peony Company be afraid of? Interest rates going up or interest rates going down? The one who's going to take the loan, what will be the worry? The interest rates going up or down? Going up. And you all know that in a derivative contract, they had opposite views about the asset, right? The views are opposite. Correct. So this person will think that the interest rates will go up. So on the other hand, the one who is providing the loan, that is the bank. What will the bank think? What will the bank think? That the interest rates will fall? You all know that in a derivative contract, people have opposite views about, the parties to the contract have opposite views about the asset. One will think that it will go up, the other person will think it will go down. It's like betting, but we don't use the word betting. That's it. So here, the Peony Company thinks that the interest rates will go up and bank will think that it will go down. So both of them have opposite views about the contract. So they enter into a forward rate agreement. So what is happening over here? The loan will be, how much is the loan that they want? 100 million loan in 3 months time. Okay. The loan will be converted into pesos and invested in a 9-month project, which is expected to generate an income of 580 million. Okay. So the loan is in dollars and then you'll have to convert it, of course. With 200 million paid in 6 months from today and 380. So in this 580, 200 and 380. Correct? 200 is being paid in how much? 6 months time. And this in 12 months time. The spot rate is given. And they've also given you the interest rates. Can anybody solve this problem? This one is the forward rate agreement. Right? For a period of 3 to 12 months. What was the loan amount? $100 million. So what happened now? They're asking if interest rate on the loan is 6.5% when it is taken out, whose prediction was right? Whose prediction was right? Bank or Peony company? Who won the bet? Think like this. Peony company thought it will go up. Bank thought it will come down. Whose prediction was right? Bank or Peony company? Who won the bet? Bank or Peony? Very good, Edwin. Bank won the bet. So if bank won the bet, who has to pay now? Who has to pay? Peony company. So with this, I can say D is definitely not the answer. Okay, so now your options is limited to 3. See, this is how you come to a proper answer. So you know that the bank has won the bet, so Peony company has to pay. So it's either A, B or C. Now let's talk about the amount. So how does this work? Calculate the interest amount. How much is the interest amount? So you know that you are thinking in the point of view of Peony company, right? So Peony company thought that the interest rates will go up to 7.1%. But what happened to the interest rate? It came down to 6.5%. So how will you do such sums? First, 100 million. How much is the interest rate? 6.5%. So pay 6.5%. But this is for the whole year. What is your duration? 9 months. So into 9 by 12. What's your answer? How much is it? Tell me. How much interest are you paying? Peony. Let's say the interest rates have gone up to 6.5%. So what is happening now? Peony company thought it would go to 7.10, but it went to 6.5. So what is the answer? 4.875. Okay. I'm not calculated. I hope that's the right answer. Let me check. Yes, $4.875 million. Now, this is the interest paid on the loan. Okay. Also, who won the bet? Bank won the bet. So, Peony company has to pay how much? The difference amount. That is 7.10 minus 6.5%. Now, again, into 9 by 12. So, how much do you get? What is the interest rate? Because bank won the bet. So, Peony company has to pay. So, how much will it be? What is the difference amount? 6.6% into 9 divided by 12. 0.45. Very good, Farhan. Correct. So 0.45 means how much? 4,50,000? Yes or no? So which one is the right answer? C is the right answer. Everybody, is this clear? C is
Yes, ma'am.
correct answer. So what should you do? Very simple, guys. You just have to think who won the bet. Okay. First, you have to check who won the bet. Person has to pay. And what amount will that person pay? The difference amount. The difference amount. Because the company thought that it will go up to how much? 7.1%. Right? But it didn't go. It went to 6.5. So the difference amount has to be paid. Okay. If it was the other way around, if the interest rate was 7.20, that time what will happen? Now who has to pay? In that case, who would be paying?
Bank.
Bank will be paying. I hope this is clear. And the difference amount. Okay. So whenever it is a loan, you will compare it with the first rate. And whenever it is a deposit, you will compare with the second rate. Next one, using exchange rate based on interest rate parity, what is the dollar amount received from the project? Okay, this is an interesting question. So first of all, you have to calculate. If you're using interest rate parity theorem, they've given you the spot rate. How much is the spot rate? Spot rate is $1 is equal to 5 peso. Right? $1 equals 5 pesos. This is the spot rate. What else are they saying? They've given you the currencies, no? They've given you what is the interest rates. Following information on current short-term interest rates is available for dollars and peso. So first of all, tell me which one is your home currency? Which one is home currency and which one is counter currency? Very good, Tony. So always remember the currency that is being quoted. When I say currency being quoted means I'm saying no, $1 is equal to so and so. So that is the currency that is being quoted. So currency being quoted is always the home currency. So home currency is dollars, counter currency is pesos. So interest rates are given to you 6.5 and 10%. Okay, solve. What was your loan? How much was the loan? 580 pesos. Out of that, 200 was for 6 months period and balance was 12 months period. Right? So what do you have to do? First check what is the forward rate. How much is the forward rate for 6 months and what is the forward rate for 12 months? Calculate the forward rate. How do you calculate forward rate? Tell me. Interest rates are given to you. So can you use IRPT theorem? Interest rate parity theory. What does it tell you? F0 is equal to S0 into interest rate in right. So solve. Spot rate is given to you. Interest rates are given to you. So how much will be the forward rate for 6 months and how much will be the forward rate for 12 months? So what should you do? How do you solve such sums? These interest rates, be very careful. These interest rates are given on a per annum basis, right? We will have to convert it in. We will have to tell it in unit basis. I mean, in monthly basis. So 6 months means it will be into 6 by 12. Yes. Hadi has given me the answer. For 12 months, it is 5.164. Okay. That's right. So it's going to be like this. 1 plus. Here is going to be 6 by 12. And here it is going to be spot rate is 5, no? Similarly, when you're doing it over here, it will be here we will take it fully. Why? Because it's for the whole year. 12 months means 1 year. So what do you get? Yes, here you get $5.16 as your forward rate. This is for 12 months. And here how much do you get? After solving, anybody? What is my 6-month forward rate? Edwin, check your answer. Neha, yes, that's the right answer. 5.08. So now you do it. Now you convert it. Now you convert and tell me how much is it. $1. So we've got this $1 is equal to 5.08 pesos. So 200 million. This was for 6 months, no? 200 is equal to how much? Similarly, over here, $1 is equal to 5.16 peso. So 200 pesos is how much? Because they're asking in dollars. What's the answer? Anyone? $39.38 and 73.65. So add these two. This plus this is your total. How much is it? How much do you get? Yes, 113 million. So can I round it off to 112.9? Yes. So it is 112.9. That's the closest. Okay. Next question, guys. Question number 29. In respect of Peony Company managing its interest rate risk, which of the following statement is I was talking and it was in mute. All right, guys. So yeah, what's the answer? Yes, C is the correct answer. Hadi has given me the right answer. Khatija, Neha, take your answer. So here, what is happening? In respect of Peony companies, you have to say which statement is correct, right? Smoothing is an interest rate hedging technique which involves maintaining a balance between fixed rate and floating rate debt. This statement is correct. What happens in smoothing of interest rates? You take half of your loan or deposit in fixed interest rate and half in floating interest rate, so that whatever happens, you are covered. So smoothing is an interest rate hedging technique which involves maintaining a balance between fixed rate and floating rate, because you take half and half so that you're ready for any adverse situation. Okay, so statement 1 is correct. What about statement 2? Asset and liability management can hedge interest rate risk by matching the maturity of assets and liabilities. Now, this statement is also correct, because what happens in asset and liability management using interest rate risk? What do? We protect ourselves, right? So, if you take your assets also in floating interest rates and like in floating interest rates, let's say if the interest rate increases, you will get high income from your assets, right? Which will protect us from high cost of liabilities. So, this is how we manage our assets and liabilities with the help of hedging the interest rate risk. So that's why both statements are correct, 1 and 2. Clear? Okay, next question. Last question. Got the answer? So the correct answer to this question is B. Most of them have given B. So why B is the answer? First of all, interest rate options must be exercised on their expiry date if they have not been exercised before then. See, this statement is false, because what is the advantage of taking option? The very advantage of taking option is that you have the option to exercise it or not. You have the option to exercise it or lapse it. So that's why A is not the right answer. Then they're saying Peony company can hedge interest rate risk on borrowing by selling interest rate futures now and buying them back in the future. Yes, this is the correct statement, right? Because what happens in futures, if you want to borrow, what do? Just remember this has been repeatedly asked. You sell futures now and buy futures later, correct? And if you want to lend, then it is the opposite. Can you all complete the sentence? Now here, Peony company is borrowing. So this is the correct statement. That is, it will sell interest rate futures now and buy back them in future to hedge itself. Similarly, if you're lending, then it works the other way around. Now, if at all the question said Peony company is lending, then what would be the sentence? Can anybody tell me? You will buy futures now and sell futures later. Of course, we don't have to study this in detail, because for this practical exposure is very important to understand. So just remember this point that if you're borrowing, you sell and buy later. If you're lending, you buy and then sell later. Okay. So that's why B is the right answer. Shall we? Which one? Yeah, sure, Tony. 28th sum, is it? Okay. This one, right?
Yes, ma'am.
Should I explain?
Ma'am, is the answer C or D?
The answer is 112.9. So that was option D, right?
Yes, ma'am. I heard it as C. That's why I just wanted to confirm.
No, this is the right answer because we get 113 million, which is closest to 112.9, like that.
Yes, ma'am. Thank you.
Okay, perfect. So, shall we solve more objective test case questions? Yes or no? Let's solve more of section B questions. Okay, perfect. So what I'll do is I'll go to our exam kit and then we'll pick few questions from business valuations. Let me share the screen. Where's the exam kit? Okay. Because your paper has more of MCQs. And today I will be posting the second MCQ. I mean, second mini mock test. For the one, the answers have already been posted. I think for one question, there is an error in the answer key. I'll let you all know which one is that. All of you can see the screen.
Ma'am,
Yeah.
ma'am, if possible, could you also send us the solutions for the minimum?
Oh, I don't really have the solutions, but if there's any question that you'll have doubts, then I can post for that particular question. You can just put it in Google Classroom and I'll just post the answer there.
Okay, ma'am.
Like which question you all didn't get the answer or you found difficulty, just mention that in the Google Classroom. Others also can help. And if nobody helps, then I will help. Just put that as a post. Okay. You all see the screen. Okay, business valuations. Question number. Yeah. So let's solve few of this and then I'll be moving to section A. Section A, I have few MCQs which we will be doing. But before that, let's do some section B questions. Quickly go through the question. Kevin Dutton is an investor who specializes in buying corporate debt at discounted values and aims to make gains either by selling bonds at a higher value or by receiving redemption payments. Yeah, just go through the question. Meanwhile, I'll answer Hadi's question. Hadi is asking, what does it mean when an option is allowed to lapse? When the interest rates or the exchange rates are not in your favor, Hadi, then you would let the option lapse. Okay, for example, let's say that you entered into a contract. See, you should always compare the strike price, okay, which is also called as exercise price, with the market price. So let's say you entered into an option contract. Okay, let's say there is A and B. Okay, both of them entered into a contract to buy and sell at rupees some asset. Okay, some asset for 100 rupees. So what is this? This is my strike price or my exercise price. Okay, who has the option? Let's say Mr. A. Okay, Mr. A has got the option contract to buy this asset at 100 rupees. Now, after a few days, okay, when it's time to exercise the contract, the market price has come down to 80 rupees. So Hadi, tell me, what will Mr. A do now? Will he buy it from Mr. B for 100 rupees or will he go to the market and buy it for 80 rupees? Which is better? Mr. A has got the option either to exercise or not exercise the contract. So what will Mr. A do, Hadi? Will he buy it from B or will he go and buy it from market? If he's buying it from B, he has to pay 100 rupees. If he's going to the market, he has to just pay 80 rupees. So what will he do?
We buy it from the market.
He will buy it from the market. So what is he doing? He is letting the option lapse. Why? Because the exercise price is greater than the market price, you will lapse the option. If the situation was the other way around, if the market price had gone to 120 rupees, then why will he go to the market and buy? He will buy it from Mr. B because he's getting it for 100 rupees. So in this situation, when your exercise price is lesser than the market price, that time you will exercise the option. These are the terms that we use. Is this clear, Hadi, and everyone else?
Yes, ma'am. Thank you.
Yeah. So going back to the question, I hope everyone has read the question. And please answer. Ashwina has given me the answer already. Okay, so this is where they're asking you to calculate the market value of Kevin's investment in bonds. So everyone knows that assumption in FM, right? That market value of an investment is equal to present value of its future cash flows discounted at investors' required rate of return. Is this statement new to you all or have you all heard about it before? Tell me that first. Let me repeat the statement for you all. Market value of an investment is equal to present value of its future cash flows discounted at investors' required rate of return. Okay, heard of it, no? Not new. Perfect. So that same logic you will be using over here to calculate the market value of the investment. So how do you start? You have to calculate the market value. You know market value of an investment is equal to present value of its future cash flows. So if you have invested in bonds, what are your future cash flows? It is the interest and the redemption payment. You know that the interest is always calculated on the nominal value of the bond. So tell me how much is the interest and how much is the redemption payment. Should I solve this or have you all got the answer? Tell me.
Ma'am, can I solve this?
Yeah, sure. So let me go to the screen. Key part of the problem. What are they asking us? Calculation of market value of an investment. Very good. Farhan has given me the answer. So we all know that statement, no? That market value of an investment is equal to present value of its future cash flows discounted at investors' required rate of return. So here 0. Here 0 is your market value. Then here, when to when? 1 to 5, right? Because what is the value of the bond? How much is it? 5 years time, right? So year 1 to 5, how much is the interest you're getting on the bond? $5, correct? Year 1 to year 5, you are getting interest of $5. Why 5? Because 5 is the interest rate. 5% bonds, and this is always calculated on the nominal value of the bond, which is $100. And what is the redemption amount? What is the redemption amount? Finally, at year 5, you are redeeming the bond. At what rate? Tell me. How much? Have they told it is redeemed at premium or anything like that? No, they have not told anything. So it is redeemed at nominal value itself, that is 100. Correct? So these are my cash flows. So what should I do now? I want to know what is my market value. You all know that market value of an investment is equal to present value of its future cash flows. Can I say the interest and the redemption amount is my future cash flows? Everybody agrees that these two are my future cash flows. But I want to know what is the present value of these future cash flows. So if I want to know the present value of these future cash flows, I have to discount it. Discount it at what? At investors' required rate of return. How much is the investors wanting? What is the interest rate that they want? To value the bonds, Kevin has estimated that the return of 30% is appropriate here. So they want 30% return. So what happens over here? In your sheet, in your present value table, it is only from 1 to 20%. That's the reason in my regular sessions, I teach students how to calculate the discount factors and annuity factors in your Calc itself, because now they're asking for 30%. Can you tell me what is the annuity factor for 5 years at 30%? This is going to be 1. How much is this? What is the annuity factor at 30% for year 5, for 5 years? How will you do it? 1 divided by 1.3. You will get it for first year. Click equal to second year, third year, fourth year, fifth year, and then click grand total. How much do you get? What is your annuity factor at 30% for year 5? Can anybody tell me? Very good, Neha. Others? 2.43. And what will be the discount factor at year 5? Because the cash flows were even, so I took 5. But at year 5, I want to know only the discount factor. How much will that be? 0.269. How did we get it? 1 divided by 1.3. This is for first year. Click equal to second year. Again, click equal to third year. Again, click equal to fourth year. Again, click equal to. So you get 0.269. So you know what is the assumption? Market value of an investment is equal to present value of its future cash flow. So this present value I want to know. That will be correct. Sum of so how much do you get? $39.05 correct? So which one is the closest? Option C. Is this clear? We can round it off to the nearest dollars. Right? So it is 391. 39.05. They have told nearest 1000. Is this clear, everyone? Any doubts?
No, ma'am.
Okay. Next part of the question. What are they asking? calculate the gross redemption yield on the deep discounted bonds. Now, what is the meaning of deep discounted bonds? So if you see in the question, I hope you guys have read the question. There are two types. Here they've told there is deep discounted zero coupon bonds. Actually, deep discount, see, if you read your sources of finance chapter, you will know that deep discount bonds are different, zero coupon bonds are different. But of course, they are very similar to each other. Okay, they are similar. They're not the same, but they're similar. What is the difference between deep discount bonds and zero coupon bonds? Can anybody tell me? What do you mean by coupon? What is the word meaning coupon? Interest rate. They'll tell you, no, 8% bond, 6% bond, 5% bond. That is called as the coupon rate. So please don't get confused between the coupon rate and the interest rate. That is the interest that you're getting on that bond. Okay. So what is the difference between deep discount bonds and zero coupon bonds? Usually deep discount bonds have a period of 7 to 10 years, whereas zero coupon bonds have a period of 25 years plus. Here it is issued at discount to, for example, your issue price minus your face value will be your interest. I mean your future value. Over here, they don't give interest at all because zero coupon, no interest at all. Okay, if there is no interest, then how is zero coupon bond holders making money? Here the yield or the return is equal to par value minus the discount price. They'll tell you what is the discount rate. So this is the difference between the two. Okay, the duration and usually the difference, how for what they issue and what they mature, no? That difference is the interest that is getting. Similar to your zero coupon bonds. This is just the theory part. So now tell me, what will be the answer? Calculate the gross redemption yield on deep discounted bonds and give your answer as a percentage to 1 decimal point. So how much is the yield that you're getting on your deep discount bonds? So first of all, you have to check how much are you giving the discount. The issue price has been set at 40% discount. That means for how much? You know the nominal value is always $100. So how much are you issuing it at? 100 minus 40%.
$60.
Yes, you're issuing it at $60, but redeeming it at this value or nominal value, correct? So can I say how many years you're keeping it? 6 years, right? 6 years. And issuing it at a discount of 40%. And how much return you need? 10%. So can I say you're keeping it for, you're issuing it at $60, you're keeping it for 6 years, and it will become $100, right? Yes or no? So can I say present value, the basic formula is your future value, correct? So 60, investors require how much return? 10% for 6 years, correct? So what is the answer? What is the rate? No, here they're asking you, what are they asking you? Calculate the gross redemption yield. So they are asking you how much will be the return. Okay, so you have to calculate how much will be the return. So I'll keep this as R. And you know, future value is 100 because it's always redeemed at this much. So how much will be the answer? Solve for R and tell me how much is it? Very good. Hadi has given me the answer. What about others? Yes. Soumya, that's the right answer. how is it? How do you do this? Can I say 1 plus r the whole to the power 6 is equal to 100 divided by 60? 1.67. Then take the sixth root on both the sides. So it's going to be 1 plus r is equal to 1.67 sixth root. So 1 plus r is equal to how much? 1.089. This you can do it using a scientific calci. So r is equal to 0.089, which is equal to 8.9%. Is this clear? This is the yield. So they've told to 1 decimal point. So that's why I'm keeping it as 8.9. So in the exam, don't go to put percentage again over here. That's not going to make sense. There is already a percentage here. So don't repeat that. Okay, we will try this. Calculate the minimum discount required so that the deep discount bonds give a return over 10%. So they are asking you how much should be the discount so that you get the return over 10%. So how is the equation? Can you all frame the equation first? You want to know what is the issue value? Issue value so that you get a return of how much? 10%. And you know what is the nature of deep discount bonds? It is redeemed at face value. So how much discount is given? They are asking. Solve. Very good, Edwin. That's the right answer. How much do you get issue value? $56.5. Okay. So if it is 56.5 or 56.45, what does that mean? How much discount was given? Because you know the logic behind deep discounted bonds, right? It is redeemed at face value. So you can do it 100, see, 100 minus 40%. You get $60. So this is not the answer. 100 minus 42%. How much do you get? 58. So this is also not the right answer. 100 minus 44%. You are getting 56. So that's why C is the right answer. Clear? Everybody, this is how you do it. 100 minus 44%. When you do, you will get 56. That is nothing but the issue value. So that's why C is the correct answer. Is this clear? Any doubts? Okay, please do this last question. Indicate by clicking in the relevant boxes whether the following statements concerning deep discounted bonds are true or false. Is it illegal? Is it illegal for the companies to issue bonds at discount? No. This statement is false. Then, deep discount bonds can help company B's cash flow. True or false? Deep discount bonds can help company B's cash flow. Is the statement true or false? The statement is true. Why? Because there's no commitment, no, that we have to pay interest every time. In case of a normal bond or a debt, we have to pay interest every now and then. But here that commitment is not there. Why? Because only at the time of redemption we have to pay. It is issued at a discount and then finally it is redeemed at par. So the difference is this one. So it's not affecting company's cash flow. This statement is true. And investors' required return will generally be low with deep discounted bonds. Nothing like that. Why will it be low? They would also want good returns only. Otherwise, why would they invest in deep discount bonds? So this statement is also false. Okay, guys, shall we take a quick break? Let's take a quick break for like 5 minutes and get back. All right. Okay, Tenzin has a question. Can you explain the C part again after the break? Sure, Tenzin, are you there?
Yes, ma'am.
Okay. So let me go back to the screen. Yeah. So here you're asking us calculate the minimum discount required so that the deep discount bonds give a return over 10% and give your answer to the nearest whole percent. So we all know that in deep discount bonds, what happens? We are issuing it at a discount to our face value, that is $100, right? So I don't know what is that discount price, okay? But I know that the investors require a return of 10%. So I have to issue in such a way that the investors get a return of 10%. And you know the nature of deep discount bonds. It is always redeemed at face value. That is $100. Okay. So I will solve this. While solving, how much do you get issue value as? For 6 years, sorry. Yeah. How much do you get, Tenzin? 1.1 to the power 6. 2, 3, 4, 5, 6. Yes. Into 100. Divided by 100. How much do you get? What's the issue value? Can I say $56.45? I'm just solving the equation. 1.1 the whole to the power 6. This will go this side. So 100 divided by 1.1 the whole to the power 6. You get 56.45. Till here, is this clear?
Yes, ma'am.
Now you have to check. If it's 56.45, how much is the discount? You know 100 minus X% is 56.45. So you check. If I do 100 minus 40%, I'm getting $60. So this is not the discount rate. If I do 100 minus 42%, I'm getting $58. This is not the discount rate because this is not the price that I've issued it for. 100 minus 44%, how much do you get? 56. So this is the issue value because you know when I issued it at 44% discount, that is the rate I am getting. Now is it clear?
Yes, ma'am. Got it. Thank you.
It's 46%, you'll get 54. This was not the issue value. The issue value was 56.45. Okay. So that's about it. Shall we do some MCQs on business valuations? Are you all ready? Everyone, are you there?
Yes, ma'am.
Okay. So I'm gonna do some MCQs. Yes. Question number 1. Which of the following best describes the replacement value of a business? Okay, Khatija gave me one answer. What about others? Neha has given me one answer. Okay. Are you sure, guys? That's the right answer, what you are saying? Tenzin has given me one answer. C is the correct answer. All those who have told C, that is the right answer. Others, just value to replace assets with new is not the meaning for replacement value. Replacement value, what does it say? It talks about starting the business from scratch when acquired. Please read about it. Remember that line that they use in replacement value, that it is started from scratch. So C is the right answer. Not B. Next, shall I go to the next question? What is the value per share using the realizable value of the business? What is the value of the value per share using the realizable value basis of valuation? So they've given you the balance sheet. Who will give me the answer? Check your answer. Okay, Joe has given me the right answer. Neha has given me the right, no, Neha checked. Joe, can you explain after 1 minute how you got the answer? No, Khatija? Value per share they're asking. So, tell me how you got the answer. Yes, Tenzin, correct answer. Who can explain? Tenzin, can you explain? What is the value of the business, first of all? Assets minus liabilities. Explain. Who will explain, Tenzin or Joe? No, that's not the answer, Tony. Okay, Joe, how did you do it? Non-current assets and net current assets is given, total assets, but they're saying non-current assets includes machinery, which will cost 10 million, which was purchased 7 years ago and has a useful life of 10 years. Moncton uses straight line depreciation and the assets were recently professionally valued at $1 million. Okay, wait, let's just keep this question on hold. I think one information is missing. Let me get back to this. Meanwhile, solve this. All right, Tenzin, let me have a look at it. Squabs PLC pays an annual dividend of 30 cents per share to shareholders, which is expected to continue in perpetuity. The average rate of return in the market is 9% and the company beta is given, RF is given. What is the expected rate of return to shareholders of the company and the predicted value of shares in the company? Okay. This is simple. Solve. Yes, Neha. Yes, Ashwina. Correct answer. What about others? What about others? I was even solving. Yes, Samya. Correct answer. Yes, Edwin. Okay. All of you got D as the right answer. How did you calculate the predicted value of the share? Because this is easy. You can use your CAPM. How did you calculate the predicted value? Who can explain? You know, perpetuity factor means how much? 1 by R. So the rate of return is 11.5%. Correct? I hope everyone has got D as the right answer. Perpetuity factor is calculated how? Cash flow into 1 by R. Cash flow is 30 cents. Into rate of return is how much? You calculated, no? Using CAPM. RF plus beta into RM minus RF. You got 11.5%. So when you do this, you'll get the predicted value also. Because this is how we calculate perpetuity factor. Everybody knows how to calculate discount factor, annuity factor. Perpetuity factor is 1 divided by R. Is this clear, everyone? Okay, next question. What's the answer? Dividend is given. R value is given. Market value is given. Tax rate is given. What's the value of the company based on dividend yield? Why is there so much silence? Who did with the answer? Got one answer. Edwin, very good. That's the right answer. Only Edwin has given me the answer. What about others? Yeah, sure. Edwin, can you tell? How did you get the answer? Proxy company's dividend is given 0.27. So dividend yield ratio is how much? Dividend per share divided by market price of the share, right? So dividend, I'm talking about turn company now. How much do you get? Market price is how much? 3. So yes, Edwin, continue.
We will get 9%.
And yeah, continue, Edwin.
Now we have to convert this 9% in the first one.
Okay, how will you?
That is 0.15 dividend per share divided by 9%.
Everyone, did you get the answer? Why are we dividing it by 9%? Why? Now at least can anybody tell me? Why is there so much silence when it comes to business valuations? You're so active. Is this clear, everyone? We first calculate the dividend yield of the proxy company, that is turn company, which is in the same industry as Gannett Limited. And then we apply the same thing over here to get the right answer. Okay, next question. Okay, we have 5 minutes. I wanted to do risk management questions also. We'll do it tomorrow. Okay. Question number, okay, let me zoom it out. How many new shares must Arcturus PLC issue to purchase the shares in Mira PLC? Last question for the day, do it. So, Arcturus PLC has agreed to acquire all ordinary shares in Mira PLC and has also agreed a share for share exchange as a form of consideration. The following information is available. They've given. Now, what A company is taking, M company. And they've given you the details: profit, before tax, after tax, share capital, P ratio. The agreed share price for Mira PLC will result in its shareholders receiving a premium of 25% on the current share price. How many new shares must Arcturus PLC issue to purchase the shares in Mira PLC? Okay. How are you going to do this? Price earning ratio is given. What is the formula for PE ratio? Market price of the share divided by earnings per share, right? So that is given for both A company and M company. That it is 10 and 12. What about the EPS, earnings per share? Can you all calculate? It's simple. $60 is the profit after tax and the shareholders are given. What is the market price of the share? Guys, you all know that. Correct. Here it will be how much? Net profit after tax is 60 million. How many shareholders are there? See, Neha, you cannot do 60 divided by 20. That's not the right way because this is given in dollars. What is the meaning of EPS? Profit after tax divided by number of shareholders. So first, that will be 20 divided by 0.5. We can't do 60 divided by 20. Please make that correction. Yes, that's the right answer, Hadi. EPS is 1.5. So most of them have the 60 divided by 20. How can we divide 60 by 20? This is the dollar amount. You know that net profit after tax is divided by the number of shareholders. How can you get the number of shareholders? 20 divided by 0.5. It will give you number of shares. Okay, so how much do you get? EPS was 20 divided by 0.5. EPS was 40. So what is your market price? Ma'am,
EPS is 1.5.
1.5. Sorry, my bad. I have taken the number of shares. So that is 60 divided by 40. 1.5. Okay. How did I get 1.5? 20 divided by 0.5 is number of shares. 40 shares. 60 divided by 40 will give you 1.5. So what is the market price? $15. And similarly over here, how much is it? Can you now complete the problem? You got the market value of the share. And what else have they told? They have told us that if A company is taking, it will be, what will be the price? The agreed share for Mira PLC will result in shareholders receiving a premium of 25% on the current share price. Right? So how will you do it? Finish the problem. They're asking how many new shares must Arcturus PLC issue to purchase shares in Mira PLC. Anybody with the answer? Very good, Edwin. Correct answer. What will be the number of shares? %25 increase divided by Who can explain this? Solve this. You all know the formula, number of shares into market price of the share is equal to value. So I have just done value divided by market price of the share. What will be the value? 120 is however there, the current value, and it is going to increase by 25% divided by market price of the share. How much do you get? Very good. Maria, that's the right answer. Others? So first step was we had to calculate the market price of the share. And then we wanted to know the value of the company. You know that? Can I say 10 into 60 will give me the value of the company? Similarly, 12 into 10 will give the value of the company. So when I did 12 into 10, why 12 into 10? Because 12 is equal to 12 is your thing. If I do this, I'm going to get the market value. Market price of the share or market value because I'm taking in total. So the market value will be $120 million. But if Arcturus, whatever is the name, if A takes over Mira, then what happens? It increases by 25%. So that's why I did 1.25. And I wanted to know what is the number of shares divided by the share price, market share price. This we know how we calculate it. Is this clear, everyone? First, we calculated the market price of the share of Arcturus PLC, which we got it as $15. Okay. The value of Mira PLC, how can we calculate? P ratio is given 12 is equal to market value or market price. Same thing. Why am I taking market value over here? Because we've got the total value, right? That is 10. Earnings of the company, I mean, right? I'm not taking it on a earnings per share basis. I'm taking the total earnings. So I get the market value as how much? $120 million, correct? And they've told that the agreed share price of Mira PLC will result in the shareholders receiving a premium of 25%. So if I'm denoting it in full value or per share basis, means the same. So it's going to become 120 plus 25%, or in other words, 120 into 1.25. Right? 120 plus 25%. So this is going to be the value. Right? Value is going to be 150 million in Mira. So now I want to know what is, and the market share price we have already calculated. So now I want to know what is the number of shares. So I just solved the equation. Is this clear, everyone? Because you know number of shares into market price of the share is equal to value. Right? Value is 150. Market price of the share is 15. So how much is the number of shares? 10. Clear? Is clear, everyone?
Yes, ma'am.
Okay. All right then. So I'm going to stop over here now. Tomorrow is going to be our last session, revision session. So in that revision session, I want to finish these business valuation questions. Okay. And risk management, I have few MCQs. So that will be the agenda for tomorrow's program. Okay. Because these concepts are more important. So that I'll be taking up them. And I'll also be posting mini mock exam 2 in the Google Classroom for your reference. I think I've already posted, no? Or I've only posted the answers. Okay, I'll check that out. All right then. Yeah, I've already posted working capital management questions. So tomorrow tomorrow I will post the answers for it and the last minimum. Okay. Yeah, answers I'll be posting it tomorrow along with the new mini mock, the final mini mock. Okay, guys. So I hope the session was effective. We'll meet tomorrow at 9 o'clock. All right. Bye bye.
Thank you, ma'am.
Thank you, ma'am.
Welcome.